Hi everyone, we're here to discuss the climate transition bond guidance that and the market actually that we published 8 months ago. I am not going to repeat all what's on screen, but I'm happy to welcome all of my panelists, Pietro, Christa, Tongai, Kotaro, and Gemma. Right. We published a guidance 8 months ago. Let's face it, we haven't been hit by a massive wave of transition bonds on the market. But let's also allow it for time. It's a new label, and it's to find its, I would say, spot or its room on the market. Investors need to qualify their appetite, and we need to also learn how to manipulate the details and the safeguards that we have introduced into it. Arguably, let's remember what the intention was behind that label, is recognizing that financing transition deserves a second leg to green. That is recognizing the absolute emissions reduction that are needed next to the green investments or the clean tech investments, not second tier, but really next to it. And I think the idea of that label was to help the market just recognize it. It was presented during the AGM yesterday. We have just published a number of Q&A helping to clarify a first wave of clarification of what needed to be, and there will be more coming in the next season. But it was based on a survey, and the survey was very clear on a number of things that the market was still expecting some clarification. But the survey was also telling us that there are diverging views on the market with regards to this market. So today we will try and understand where we stand, what's the challenges, what's the investor view, and maybe, Christa, I'll start with just a question, a very macro question of how does this fit into the wider context of the last 8 to 9 months, and how does it fit with the very intention behind the product, in your opinion?
Yeah, thank you. There are, if we step back for a second and we think about some of the things we've heard throughout the day and what's been going on underneath the green and all the labels we have in the market, what we're remarkably good at is financing green mitigation activities. So I want to start with that. We recently passed a milestone at S&P. We've published 1,000 SPOs. So it's maybe only exciting for us at S&P, but it offered us a chance to reflect and think about what did we learn from this experience. And one of the key findings was that actually the SPOs that we have done were by and large for investment-grade established mitigation technologies. Things like electric vehicles and renewable energy. So maybe not a big surprise, but it's worth reflecting that actually the market is really good at financing green. We've got a healthy, stable, green and sustainable bond market that's recently surpassed cumulative issuance of 7 trillion. So with that as a context, we're good at green, we're just getting started on transition. I think I termed this last week as transition 1.0. I don't think it's the end game. I think we're at the beginning of the game. The reason I say that is because we've taken what we know about green and the label, and largely in the start of a European context, and we've taken that and done a tremendous amount of work and created a transition label based on what we know. And I think that the challenge with that is that transition is an action, it's a verb. It's not an end state, so it's a hard thing to put into a static label. So I think, again, we've done a tremendous amount of work, but I don't think we're at the end yet. I think we're at that beginning because we still need to recognize that it's a movement towards something more sustainable, more green over time. And we're going about it in a fairly complicated way. So we have to wait and see, continue to experiment, and then hopefully we're moving towards transition version 2.0 or 3.0, where we're getting that dynamic and we're getting the financing dynamic and moving in the market.
That's interesting and probably showing us a rather long way. Gemma, as we've mentioned many times today, ICMA and LMA, APLMA, LSTA have published within weeks very similar guidances trying to encompass the transition in all sorts of financing instruments. Can you give us a sense of what you've observed since the publication, and maybe confirm or adjust what was the intention on the private markets behind those labels?
Yeah, I think it's important to say that the intention did not come about because the associations thought it'd be fun to have another label. So that was not the driver behind the work. It was more to do with the fact that I think at the entity level, everyone is very comfortable with the sustainability-linked instrument. It is a well-working entity-level transition instrument, not only transition in climate transition, but for also broader sustainability objectives depending on the borrower's underlying strategy. The question when we started to approach the use of proceeds structure was slightly different. It's what are we trying to finance? And more importantly, what's the gap we're trying to address? And in recent years, the feedback we were receiving is institutions have obviously made excellent progress in setting up their transition strategies. They've set ambitious long-term objectives. They've articulated where they want to go. But what was missing was the granularity on how they were going to get there. What were the concrete actions, investments, and projects that were going to enable the transition? So what was going to turn the ambition into a pathway? And that is what we were initially trying to address. So the transition use of proceeds instrument looks at the specific activity and project that's being financed. So it's one of the levers to achieving the transition strategy, to ensuring that capital is being deployed and the borrowers are moving from those commitments to implementation. And I think it's safe to say that we can't pretend that thousands of deals have been done, but that again comes back to what was the intention behind it. And again, I don't think the intention, success is not going to be measured in terms of the number of labels, but it's whether the loan and the bond associations have sort of set the foundations to help channel the capital towards real world actions. So you might use the principles as a foundation to have the conversation. You might not apply the label, but hopefully you'll get capital moving. And I think the label may happen. It'll be nice if it does happen, but I don't think that should be the ultimate indicator of success as to whether we've achieved what we were trying to achieve.
Maybe Pietro, you can share with us, if I can just rebound on what you just said, and share a personal opinion. It's something I've really believed for a long time, but for an issuer, whatever the actual nature of the issuer, my strong conviction is that if you build a sound transition, and if you're an industrial issuer, all the more, if you build a sound transition planning, you actually need all of the instruments. You need the sustainability linked to keep the cap, to have the overall and overarching ambition. You need the green and the transition financings because they are both going to be building your transition strategy. So, what you're saying is definitely ringing a bell to me. Maybe Pietro, you can give us, and you're here, let me precise, with both hats, both the underwriter and the issuer, and you've been one of the few financial institutions who has published a new issuance framework, which does have a transition label leg, and it is not just an issuance framework; it's the mirror of one of your lending frameworks. So, can you just give us a bit of background of what was your journey to building those two frameworks, and how much you've used them, especially on the lending side?
Absolutely. Thanks for having me. It's the presentation is quite important because indeed I get the opportunity to cover 120 customers and as advisors, but one of those is actually NatWest Group as an institution that issue this type of instrument. So I've been working on and leading this project for over a year as we're trying to develop the infrastructure for then finance this instrument in the market. And it really started back in the days. I think just to give you some historical context, NatWest Group had initially set the 100 billion of climate and sustainable finance between 2021 and 2025. Then at the end of 2025, the target was doubled to 200 billion, and there was a transitional element added to that. And within that context, the group started to develop a lending framework, so the climate transition financing framework, which is really an internal taxonomy to define what transition is and where we draw the line and how we tag the loans, the assets on our books. And then the natural evolution to that was really try and think about how we embed that element into the capital market framework. So what we then call the sustainable and transition financing framework. So it's the evolution of the green social sustainability financing framework that the group has been using for a number of years. For group, it was really kind of a natural next step. NatWest Group have been issuing thematic bonds for a number of years. You'll be familiar with, the women-led social bond, the EV green bonds, the green buildings bond, and so really embracing this thematic concept, we began to brainstorm how we bring in that element. And so on the one hand, we now have the infrastructure to tag this instrument internally that we can then hopefully in the future use to refinance in the capital market. So we've not issued yet a transition label bond, but now we do have that in the framework. We also have the sustainability-linked loan refinancing bond technology. So we're really looking to work with the market participant to understand where demand is and what is going to be the next step.
All right. Maybe as an SPO provider, Christa, you can share with us some of your insights on the not yet published transition bond SPO or published?
We don't have a published one yet. That's true. Still in progress. So we have a pipeline, but nothing
but on your discussion you've had and where just give us a bit of feedback on the appetite you're seeing, the challenges that were shared, and echoing your introductory comment that we're going to probably trial and error a few times.
Yes, and I think, Orith, you said in the beginning that maybe we didn't really expect a huge pile of transition labels to come to the market right away, and I think that fits with my expectation as well, that it's a little bit of a trickle effect, and I think it takes some time to get comfort and experience with the label, and to understand that it can be done in a credible way. So our experience has been, we've got some things in the pipeline, and we've been having a lot of conversations, and they've been a little mixed in different regions. I mean, we've heard from some intermediaries, do we really need so many labels? So I think that, let's see how the uptake is. But then there's also certain jurisdictions that either have a taxonomy that already covers the amber or transition space, or it's in the works, like Canada, for example. So I think if we look at different jurisdictions, there may be some supportive elements that are helping create that common language that maybe then would follow by issuance under the new label. But our experience in approaching transition is long-standing and predates the label. Of course, so I led the development of the Shades of Green methodology back when I was at the Cicero Climate Research Institute, and we spent a lot of time, if any of you have experience with academic researchers, we spent a lot of time debating. And we did in that instance too about whether green was binary or not. This was before the EU taxonomy. Anyways, the strong decision that we came to was that actually we wanted to reflect a spectrum in our approach, which we do not only in light, medium, and dark green, but also yellow, orange, and red to cover that whole transition space. And I wanted to come back to that transition being an action and a movement concept, because our approach allows for, no matter where you are in a region, in a sector, or with a company, no matter your starting point, you can measure that progress over time. So that is a key part of the methodology that we use when we're looking at green financed activities, and that's regardless of the label. So we have been using light green underneath the green ICMA label, and now we can see also potentially yellow and orange under a transition label, and there's a little bit, at least in the ICMA label, a little bit of fluidity about where that fits in.
Thank you. I think Rover and the previous panel opened a bit of that discussion, but we have Tongai with us today representing the investors, and arguably, or at least that's what many of us have been also saying, a key to unlock the potential of this market is vocal investors and their ability to make to showcase their appetite. And we have the feeling that for the reasons that we've started to touch base on, a number of marketplaces have been so far a bit shy, expecting to look at what the market is going to produce, which, as I said yesterday, I think it's a bit of the cat and mouse issue. And I think it would be interesting to hear you specifically at Rowe Price, but also more generally among the investor. How do you explain some of the wait and see that we are observing, and what's your actual take on the product itself?
Thank you very much. Firstly, thank you for the opportunity to be on the panel. Thank you to Bocconi, incredible institution, for hosting us. But to your question directly, with your permission, I would maybe replace shy with measured. So let's start with that.
Fair enough.
Intervention. I'm going to make 3 very quick points, and keep in mind I'm here representing Tiro, and there are many other very talented investors in the audience representing other institutions. But the first point I would make to the group is capital markets, in our experience at Tiro, rarely scale in a parabolic manner. So please keep that in mind. I know, Orith, you said we're 8 months in. Again, with your permission, I would say keep in mind the guidelines were issued in November, December. We have many issuers here who can maybe tell us whether they do a lot of trades around that time. So let's call it 6 months. So there's that first bit. Capital markets rarely scale super quickly. That happens in instances. The second point I would really encourage all of us to think about is to think about the global context. We have many esteemed colleagues. Kotaro-san and I know each other very well. I'm sure he would talk to it. But be aware that a lot is happening out in APAC. A lot is happening in APAC. There are changes in frameworks that are going on today. Kotaro-san, I'm sure, can talk to it. There are also Japanese-specific rating agencies in the audience today. Talk to them. Ask them what is going on. So, and I would also note, I was in the panel earlier where Manuel from CAF also made the point, as he always does so eloquently, that transition finance matters as well for LATAM. What I'm pointing to here is there are large parts of the world where transition finance has to move, and it has to scale, and it has to come on board. So APAC, we've seen data out of the IMF at Tiro, which suggests there's an 800 billion climate finance gap, and a lot of that is in the hard-to-abate sectors. So we think it's coming. So that's the second point. The third point, talking to our own clients, asset owners, and what they are asking of Tiro, and maybe this is just a Tiro-specific thing, but there are some very sophisticated asset owners who are entering into the conversation today and are asking us very pointed questions about transition finance. Now, just keeping it super anonymized, some of them you can imagine are in the insurance sector where they have long-term liabilities, where potentially they want to think through transition financing on their liability side, but also how do they match some of these long-term liabilities. And I think once the asset owners get involved in that conversation, things could move, and they could move in volume. So 3 quick points there.
Thank you very much. And before we give the floor to Kotaro to give us a bit of an APAC and Japanese experience, maybe Gemma, because I know you have to run. I wanted to also get you to give a word, just following on what Tongai was mentioning, on, we've mentioned it since yesterday a few times, SFDR 2.0, SDR. How do these products, labels fit or do not fit into it? Is it an issue to your opinion?
We'll see. I think obviously SFDR 2.0, the new Article 7, is going to be our transition category. Whether that translates to a label, I think, is a bit of a question mark, and whether it translates into a label or usage in the absence of the amber category in the EU taxonomy, I think, is probably up for debate. On the SDR side, I think the FCA came out with advice recently that transition isn't necessarily in the improver label, but could sit across any of them, which I thought was advice. I'm not going to say what kind of advice, but it was advice. And I think that's what we're seeing in the UK. You're seeing very high political statements about the use of transition. The FCA said you can use transition across any of the labels, but that doesn't actually help with the implementation piece, and what does that mean? And so do I think the labels help? The articles help? Yes, as a signal of intent from policy drivers. Do I think that's going to speed up allocation or issuance beyond what the market would achieve without it? No.
Fair enough. Some would probably be a bit more severe than you are. Kotaro, we've been saying ever since we started the discussion that it is APAC driven, and it's a way of also saying it's very much Japan driven. Japan's been the early laboratory of transition labeled products with its own initiative at first. But what would be interesting for us is, you've had at Mizuho an internal approach to transition financing for quite some time. Can you share with us practical examples of these type of financing and how you make it fit into capital markets, or you want to make them fit into capital markets operations as well?
Thank you very much. Buongiorno and good evening. I'm Kotaro Sueyoshi. I newly joined Mizuho Securities 2 months ago, so I'll do my best. And I want to share
your previous experience at Mizuho.
And firstly, I sincerely thank ICMA for this opportunity, and also I'm so excited to be here and engage with outstanding leaders in these spaces. So I like to share 2 things. First one is the our CT bonds issuance, and also challenges for going forward. And so for the what's going on in Japan is, as many of you know, that Japan has been actively developing the transition finance even before the CTBG released. So we have done issuance with the CTFH, right? And also Mizuho Securities are very active. And since publication of CTBG, we already seen not a few issuers updated their framework aligned with CTBG already. And then the range of issuers are very wide. And I would like to share this. It includes the sovereign Japanese government, and also steels, automobile, and also power utilities, power electric companies. So in total, 8 issuers already updated their frameworks. And not only updated their frameworks, 3 issuers already issue bonds based on CTBG. The first one is Japanese government sovereign, yes, And they plan to continue to issue. And second one, third one is the first one is steel, and third one is electric company in Japan. And both issuance are 10 years bonds. And I heard that demands for those bonds were very big. And one key reason many issuers already updated their framework is that recognition that CTBG alignment will give them more clear transparency around their strategy, and also that could be great tools to show their intentionality for real world decarbonization, right? Because CTBG has impact reporting parts. And I think that is very important, and that sends a very strong message to issuers. So issuers think more, financial institutional investor will have much higher appetite for transition finance bond with, impact reporting and transparency. Right? And may I continue? Thank you. And also, however, scaling transition finance is not that easy. And I've been here for only 2 months, but in my opinion, there's 3 issues we have to tackle. The first one is the commercial viability of technologies, right? If you talk about hydrogen or any new energy, which is categorized as transitional technologies, nobody knows which one is the right one for the future right now. So we really make sure that commercial viability of those technologies if we want to invest. And second, I think sense of intentionality or aspiration is very important. Maybe you could say impact, right? And third one is that based on first 2, we really need to think about how we engagement going forward. Because to me, bond issuance, when you issue bonds, you really engage before issuance. But after your bond issuance, I don't see that much engagement with between investor and issuers. And if you really want to translate your economy or society, you really need to engage with them to make sure that you are going to make an impact to real world, right? So that's my takeaway right now.
Fair enough. Maybe I can turn to Pietro and get a bit into the debates that that we had as part of both forums, with the LMA and ICMA. And one of the, I would say, the hot topic was around nuance between green and transition. It's fueled many discussions, and admittedly, there probably are quite a number of green frameworks, with a bunch of light green or transition or climate transition projects as we define them here, because you've had that experience in trying to establish this tagging system. I'm sure you've made choices between various types of assets and where to get them to fall, because for the benefit of all, the guidelines didn't end up settling the debate. It ended up recognizing there might be some overlap, and it's up to the issuer to recognize it and be very crystal clear on how they handle it. So your experience in that tagging system would be very beneficial, I think.
Absolutely, very happy to be. To cover that, I feel quite passionate because just to give you some context, as we work on the framework, I had more than 60 internal stakeholders providing comments, feedback, sharing their opinions. So imagine what coordinating...
Your own little working group from ICMA,
Exactly.
basically.
So imagine coordinating different views and try and get feedback, everyone commenting. It was a pretty big challenge. And I very much agree with what you say. I think you really need to try and draw the line between what is climate and what is transition. When we work on the NatWest group framework, the fundamental approach that we've taken was climate finance is really kind of the end solution, the available solution, purely focused on renewable, zero or nearly zero emissions, whereas transition is where we had a little bit more of a debate, but is really thinking about where you have marginal improvements in terms of transitioning the economy. We obviously took into account different guidelines and frameworks, the International Energy Agency recommendations, and many others. I think the climate transition bond guidelines were also very helpful. The appendix in particular, there were like some specific examples there, albeit you mentioned that they're not an exhaustive list. And I cannot tell you how many conversations I had with my internal people just trying to bring that point across, because they were expecting that list to be a comprehensive list. And you really need to educate them that this is really just an example and you can deviate, develop, have your own interpretation. So that was really a big factor. Some challenges do remain. I think, for example, for us, we remained pretty anchored on what is green when it comes to buildings and energy certification, like a BREEAM, for example. In the lending framework, for example, we had very good. In the framework, we had excellent, but it's just a small nuance, but we kept it as green. For electric vehicles, really only focus on pure electric vehicles, and we removed the hybrid component. And then I think the big discussion was also with regards to retrofitting of buildings. I think the EU taxonomy defines them as kind of transitional, but we felt that the market is really settled on green, and especially with our European footprint, we felt that that was more, for the moment, appropriate in the green category. On the transition side, I think smart meters, we actually moved to the transition category. There was a lot of debate, right or wrong. We just put them there. We saw that more of a marginal improvement and arguably more transition. Some element of nuclear power are in the transition framework at group. And then everything else that has to do with carbon capture, aviation, shipping, blue hydrogen is where we landed on transition. And allow me a small deviation on that. I think it's so important that we set the right expectations on the transition label bond market, because what I fear is that we get caught into this excitement of a new standard release in the market, and suddenly we see, I don't know, 100, 200, 500 billion issuances overnight. That I don't think is going to happen. I can tell you that we went through an incredibly long process. You need to have the system in place to tag the assets, and then you begin to think about capital market activity. And so let's make sure we set the right expectations. Let's try to think about what we think this market would look like in terms of issuances in 2 years. I don't have a number in mind, but if I draw some parallels to the EU GBS market, which is obviously very much European as of now, that is 20 billion in 2025, and to date is another 20 billion, so it's like 40 billion total issuances. If you think about the GSS market, it's probably around a trillion of issuances a year, 800 billion to a trillion a year, for a total market of 6 to 8 trillion. So let's just slow down and set the right expectation, because I'm really scared that we get caught into this excitement, and then as we don't see the supply that perhaps we had in mind, it was an unrealistic figure, then this creates like kind of a negative cycle, and the market doesn't take off. It will take a couple of years.
Yeah, I'm sure, and I think the examples you gave are quite fascinating, and I'm sure, Christa, it rings a bell in the early discussion of the shades of green, because you just make the choices according to the, I guess, the transition magnitude, the transition contribution magnitude of the various technologies. And we could probably have a very lengthy argument on each and every example you just gave. So it's, I think it's, it's a very good testimony of the choices that we all are going to make. And I think it's important to just bear in mind, this is the nitty-gritty of a label. What we really want to make sure we don't lose sight of is the actual emission reduction that we are driving with these investments and capital allocated, and hence also the very powerful addition of phase-out costs in the possible use of proceeds of the transition bonds. Maybe Kotaro, one additional question. There was a hope, not necessarily always acknowledged, but there was a hope for ICMA to produce the transition taxonomy for the rest of the world. Well, this is not happening, and it's not its remit, and then any attempt that looked close to any of it was killed in a very subtle or unsubtle manner. But examples were examples. And the only thing we could do to have a reference point is just mentioning taxonomies. And the EU taxonomy has made our life a bit difficult because it was collectively pinpointed as green, whereas there was a transitioning element to it from day one. But that subtext wasn't really considered by the market, and everything's been tagged as green. But other taxonomies have made a very different call and made it very clear that type of nuance and choices that Pietro just alluded to. Maybe, Kotaro, you can give us a bit of your experience on the use of other taxonomies in both the Japanese and the APAC context, and you know, how to navigate also the national roadmaps and those taxonomies, which, you know, have different starting point. I think it would be quite interesting.
Thank you very much, of course. Let me highlight the example related to taxonomy in Asia. So last October, we saw the first transition loan. This is not bond case, but the loan aligned with the Singapore Asia Sustainability Finance Taxonomy, right? And then, which is classified as the amber category. And then that was the 500 million Singapore dollar transaction for YTL Power Seria, which financing a hydrogen-ready combined cycle gas turbine project in Singapore. And then the project also aligned with APLMA, right, and guideline, and also integrates multiple components from efficiency in components in existing gas-fire plant to hydrogen readiness, and also CCS development. So it is very, you know, combinational and holistic project in collaboration with, you know, partner with outside partners such as Air Liquide and GE. So it is very, you know, huge project. And of course, such, you know, project have raised discussion around carbon lock-in and transparency, and also. So from that experience, I really think the, you know, this highlights importance of a global standard as ICMA importance. So we need to work in, you know, in a complementary manner with, you know, local taxonomy and also global standard like ICMA. Okay? So global standard give us very, you know, credible, you know, transparency and, you know, kind of credibility for our project.
And then it's to be adapted to all the regional.
Yes.
Maybe Tongai, you can share with us also your view on the stated ambition to be adapted to local realities, which is probably a headache for international players, How, I would say in general and in this very context, you as investor, kind of make the math of the level of ambition applied to each regions and how to fit the label products into this.
Yes, thank you again, Orith. So I would tend to agree with Kotaro-san. Local context matters. It's important. But having said that, it is super helpful, and one of the things we talk to a number of issuers, once you've got that local taxonomy, please help us map it back to the ICMA CT Climate Transition Bond Guidelines, CTBG. And a number of folks are already thinking through that. So I'll just talk very quickly. We've talked a lot about APAC, but just to again bring very practical examples, Canada is at the moment working through its Made in Canada taxonomy. They've been super clear. Transition finance is going to be part of that, and they are looking to potentially issue 10 billion Canadian each and every single year and potentially build out a curve. Now, that's, by my maths, depending where the Canadian dollar exchange rate is, it's about 7 billion. That's, I think, going to have a very important catalytic impact, because if you think again to the super important role the SSA sector played in terms of getting the green bond market up and going, I think that's probably what you see here. Now, in terms of things we would be looking for, it's all the things I think which ICMA has been super clear, and a lot of folks here have worked on those, the Q&A, the actual bond guidelines. All those safeguards are really important, and I won't go and relitigate them, but they are very obvious. And I think as an investor, if we get that level of incremental information, it's so helpful. We're able to play, I think, potentially in those transactions. I'll stop there.
And accommodate the regional realities. Maybe Christa, before we close off the discussion, I think one of the headache of the whole thing is we all made, both in the LMA and the ICMA context, the vow to keep this under the Paris Agreement wider umbrella. So kind of keeping the end game outside. The reality is that many of the projects we are talking about are challenging from a carbon lock-in perspective, are challenging from a technology readiness perspective, or the lack of alternatives. We've done at Natixis one transition loan since the publication of the guidelines, and it was in the airline industry. I can tell you, within the team, we had quite a number of headache when it comes to the actual end use of the very objectively decarbonizing investments. So I'd love your, I would say, long-term history behind it, because CCR was one of the first to really put on the table the rebound effect and the lock-in topics. How do you see in the discussions that you've started the ability and the readiness of the issuers to clearly address these topics, and how much of the grand scheme of things we need to bear in mind when looking at these types of assets, which will impact quite drastically the absolute volumes of emissions?
You saved the toughest question for last. Thanks a lot. Yeah, I mean, we're in a situation right now geopolitically that impacts the transition. That's just where we're at, and it impacts it in different ways. It's not always negative on sustainability goals. It can also be positive. But where we have energy security top front of mind for almost every country, there are trade-offs. Sometimes it means delaying sunset clauses with coal-fired power plants. Sometimes it means doubling down on incentives for renewable energy. Sometimes it means we need everything on the board because our energy demand is increasing so much with AI. So there's so many factors at play here where we need to meet massive increases in energy demand at the same time we need to secure energy supplies. That plays out so differently in different regions, and I think we'll have to see, you know, where we end up. But we're in a really tough spot. We've all felt the heat today, yesterday, throughout Europe. Things like heat stress, flooding, hurricanes are going to be increasing in magnitude and in frequency over any climate scenario you look at for the next 10 or 20 years. And the only way we start changing that dynamic is by reducing our greenhouse gas emissions, reducing that trajectory now. So we're already behind our goal by quite a bit. But I think as long as we don't lose sight of that goal and we look for opportunities to support renewable energy in that energy security mix, I think that helps. I also think it's incredibly helpful to have these new labels and experiment. I know I said we're only at transition 1.0, and I do believe that, but I think that the one thing that we need to do is keep experimenting on transition because we still need to get it right.
Sounds like a nice conclusion. Being allowed 3 to 4 words each, can you provide us with your key recommendation to unlock the potential and you know, test and iterate on that transition 1.0 type of products?
Happy to start. I think we need to focus on three things. So short term, what I'm looking forward to seeing is really more call-outs from the investors in terms of this was a very good example. Put them into your impact reports, because that will be a massive driver. It will really inspire other issuers to be call-out and have that marketing effect. That is incredibly powerful. In the midterm, short to midterm, I think I'm really looking forward to continue to see this critically constructive attitude from the buy side. Go into meeting, have a conversation with issuers, do challenge them, but kind of work with them to try and develop the right product, because it will take time and it's not going to be perfect right off the bat, but just maintain that critically constructive attitude. And I think in the long term, I'm really looking forward to seeing more technologies to more easily track this information internally, because at the moment it's just incredibly cumbersome to tactically track this information, and we really need to have a system in place so that you can then channel more of this money into the capital market.
That was a bit more than 4 words, but thank you. Christa.
More innovative frameworks.
More innovation.
See more.
Okay.
Look, I'll keep it simple. We really, all of us, need real-world transition. We feel this is the way. We're super optimistic on this. We are not delusional, to be clear, but we think there's enough out there. The ICMA interventions, the Q&A, please look at these. I'll stop there.
Thank you. Yes, Rome wasn't built in a day, but we don't have time, so we need to engage among stakeholders. And also, I think we have to, you know, have a discussion with the, demand side of green, services and manufacturing, because we really need a market for those, products, green products. Without that market, we don't have chance to finance.
Thank you very much. And thank you to all of you for contributing to that discussion. And just let's make it happen then.
Thank you.